Welcome to this special deep dive into Barclays. We are looking at ticker symbol BCS, specifically their Q2 2026 earnings call.
And we should probably warn you, bank earnings are notorious for putting people to sleep.
Oh, absolutely. They can be incredibly dry. But our mission today is to cut through all that corporate jargon, deliver the most critical data points, and give you an actionable, really opinionated bottom line.
Right, because reading standard earnings transcripts is, it's like reading a stereo manual in a foreign language.
Yeah, that is the perfect analogy. So we are going to act as your translation engine today. And to kick things off, Barclays just posted a 43% jump in earnings per share for the second quarter.
Which is just a massive wake-up call for any investor's portfolio.
Right. If you see a metric like that coming from, a nimble Silicon Valley tech startup, you just kind of nod your head, check the valuation, and move on.
Yeah, it's par for the course in tech.
Exactly. But when a centuries-old, globally, systemically important British bank suddenly prints a 43% jump in earnings, that's an anomaly. That demands an immediate explanation.
It really does. You do not just gloss over a number like that when it's attached to a balance sheet of this magnitude.
Right. So we've got the transcripts, we have the supplemental financial data, and all the management commentary. We need to figure out if this institution has actually found a new gear, or, and this is my biggest fear, if we're just looking at a mirage created by financial engineering.
Well, look, that skepticism is completely warranted. A 43% jump in EPS at a legacy institution like this immediately triggers alarm bells.
Yeah, the first thing I think of is share count manipulation.
Exactly.
Yeah.
So before we dissect all the structural changes inside their investment bank or, the consumer credit divisions, we really have to establish the baseline reality of their income statement.
Let's drop those big data bombs right now. Top-line group income hit £8.3 billion in Q2.
Right, and that represents a raw increase of £1.2 billion compared to the same period last year.
So right out of the gate, we are not just looking at a bank that is frantically cutting costs to manufacture earnings.
No, not at all. We're looking at an entity experiencing broad-based franchise growth. The money flowing through their actual operations, the top-line revenue, expanded by over £1 billion in a single 90-day period.
That is just wild. And profit before tax came in at £3.3 billion.
Which translates to a growth rate of more than 30% year over year.
Okay, but we have to stop right there. Let's look at the gap between those two growth metrics. Profit before tax grew by 30%, but earnings per share grew by 43%.
Yeah, that 13% delta is exactly where your skepticism comes in.
Exactly. If you are holding this stock, management executed £3.2 billion in share buybacks over the trailing 12 months.
Right, which is a massive amount of capital to return.
And when a company aggressively buys back its own stock and retires those shares, it shrinks the equity base, right? It reduces the denominator in the EPS calculation.
Oh, mathematically, yes. You could have a completely stagnant underlying business, but if you shrink the share count enough, your earnings per share will magically rise.
So this is the question we need to answer for everyone listening. How much of this 43% headline is actual organic business expansion, and how much is just a mathematical illusion?
It's the critical distinction to make. The buybacks absolutely amplify the per-share metrics. £3.2 billion is a massive withdrawal of equity.
It totally distorts the number upward.
It does. However, when we strip away the buybacks and look purely at attributable profit, so the absolute money the business generated that is available to shareholders, that figure was organically up 36% year over year.
Oh, wow. Okay, so 36% organic growth.
Yeah. The buybacks basically acted as an accelerant, pushing the EPS from 36% up to 43%. But they were accelerating a base that was already surging on its own.
Okay, that changes the narrative entirely. The underlying machinery is genuinely generating significantly more absolute profit.
Exactly. And we see that reflected directly in their return on tangible equity, or RoTE, which came in at a very healthy 16.1% for the quarter.
Let's drill down into that 16.1% RoTE, because for anyone following banking, that is really the ultimate scorecard.
It absolutely is.
Just to translate for a second, return on tangible equity strips out the intangible assets like goodwill from past acquisitions and looks at how efficiently management is deploying the actual hard capital they hold.
Right. And a lot of major global banks really struggle to consistently break 10 or 12%.
Especially when they're heavily capitalized to meet all those regulatory stress tests.
Exactly. So operating at 16.1% means Barclays is clearing their cost of capital by a wide margin.
But I have to imagine an aggregate number like that masks a lot of internal turbulence.
So,
Barclays isn't just one monolithic thing.
No, not at all. They operate a UK retail bank, a corporate lending arm, a US consumer credit division, and of course an investment bank.
Right. So to understand how they hit that 16.1% return, we really have to isolate which specific engines are pulling the train here and which ones are just along for the ride.
Well, if we isolate the divisions, the standout protagonist for this quarter is undeniably the investment bank.
Okay, let's get into that.
And this requires a little bit of historical context to really appreciate. Traditionally, Barclays has been heavily weighted toward fixed income, currencies, and commodities, what Wall Street calls the FICC division.
FICC, right. For decades, that was basically the core identity of Barclays capital markets business.
Exactly. The CEO, C.S. Venkatakrishnan, actually acknowledged this structural legacy right on the call. He said Barclays is the house that fixed income built.
Which is a great line, but fixed income trading is notoriously volatile, isn't it?
Highly volatile and highly capital intensive. I mean, when macroeconomic conditions shift, FICC revenues can just evaporate overnight.
And that drags down the entire group's return on equity.
Right. So what we are seeing in the Q2 data is the result of a deliberate, aggressive, strategic pivot away from that legacy. They are intentionally moving the weight of the house onto equities.
The shift is actually kind of jarring when you look at the raw allocation in the transcript. They moved equities from representing 22% of market income in 2023 up to 32% today.
Yeah, a 10% swing in that short of a time frame is massive.
Reallocating a tenth of a global investment bank's market income in a couple of years is like trying to execute a handbrake turn in a cargo ship.
That's exactly what it is, and it's showing up in the returns right now. The investment bank's overall RoTE jumped to 16% this quarter, up from 12.2% last year.
And that was driven by equities income growing by a whopping 44% year over year.
Yes, a 44% jump.
But wait, I have to push back here. Building an equities business isn't just about going out and hiring a few more hotshot traders, right?
No, not at all. They are specifically targeting prime financing and equity derivatives.
Okay, let's dissect the mechanics of prime financing for a second, because that seems to be the quiet engine generating all this capital-efficient return. What exactly is it?
So prime financing or prime brokerage is basically the suite of back-end and financing services that a bank provides to hedge funds and really large institutional asset managers.
Okay, so if you manage a multi-billion-dollar hedge fund, you don't actually execute and settle every single trade yourself.
No, you use a prime broker. So Barclays lends these funds the cash to employ leverage. They lend them the securities they need if they want to execute short sales.
Right.
They clear the trades through the exchanges, and they act as the custodian holding the actual assets.
So from a bank's perspective, that sounds like a highly attractive business model.
It's incredible. Once you build the tech infrastructure and you secure those big client relationships, prime brokerage generates incredibly steady, predictable fee streams.
And interest income, too, from the leverage loans, right?
Exactly. And the best part is, it doesn't require the bank to take massive directional market risks. They aren't betting on the direction of a stock.
Which makes it highly capital efficient compared to, say, proprietary trading or just holding massive amounts of corporate debt on the balance sheet.
You nailed it. They're essentially selling the picks and shovels to the hedge funds.
And they're collecting a toll on every single transaction and every dollar of leverage. That makes total sense.
And if you look at the transcript, it noted that roughly 80% of their growth in this prime financing area came from their top 100 global clients.
With a particular emphasis on expanding their footprint in Asia, I noticed?
Yes. They aren't trying to capture a massive volume of, smaller funds. They are embedding themselves deeply with the largest, most active institutional players in the world.
And that capital efficiency metric you mentioned earlier is the real key here. The data shows their income relative to average risk-weighted assets rose to 7.7%.
Right. Risk-weighted assets being the metric that dictates how much dead capital a bank has to hold in reserve, just in case things go wrong.
So if they can increase their income without significantly expanding those risk-weighted assets, that flows straight to the bottom line.
Exactly. Which perfectly explains that jump to a 16% RoTE in the investment bank division.
That is the exact mechanical linkage. They are squeezing higher quality yields out of the exact same regulatory capital footprint.
It's beautiful execution. But, the investment bank pivot is really only half of the structural story driving these earnings.
Right. We have to look at the corporate and retail banking side, too. Specifically, how they manage their interest rate exposure.
Yes, because a phrase that completely dominated the Q2 earnings call was structural hedge income.
Yeah, that came up constantly. The management team disclosed that the structural hedge accounted for roughly 45% of the group's entire net interest income in the second quarter.
Which is staggering. When a single internal treasury mechanism is responsible for almost half of your interest income, we have to completely deconstruct how that works for the listener.
Absolutely. Let's build a mechanical model of this. A bank takes in deposits, let's say billions of pounds in everyday retail checking accounts.
Right, just normal people leaving cash in the bank.
And those specific accounts usually pay the customer 0% interest, or maybe something very, very close to it.
Yeah, they're practically zero-cost liabilities for the bank.
So the bank takes those zero-cost liabilities and lends the money out in the form of mortgages, corporate loans, and credit cards at much higher rates.
Let's say 6%, for example.
Right. And the spread between the 0% they pay the depositor and the 6% they charge the borrower, that is their net interest income.
Simple enough, but there's a massive duration mismatch there.
Exactly. The loans might be fixed for 5 years, but what if central banks slash interest rates tomorrow?
If rates plummet, the yield on all the bank's new loans drops instantly. But their deposit costs can't drop any lower than zero.
So their profit margin just gets completely crushed.
Right. And to prevent that volatility, the bank uses a structural hedge. It basically acts like a massive financial shock absorber.
I love that shock absorber analogy, because for a retail investor, it's kind of like locking in a high-yield CD for a few years, but just on a multi-billion-pound scale.
That's a perfect way to look at it. To manage that duration mismatch and smooth out the volatility of these central bank rate cycles, Barclays' Treasury Department takes a large portion of those stable, non-interest-bearing deposits and effectively locks in a fixed return over a multi-year horizon.
And they do that using interest rate swaps, right?
Yes. They agree to exchange the floating, unpredictable market interest rates for a fixed, guaranteed rate with counterparties in the derivative markets.
So by doing this on a rolling basis over, say, 3 to 5 years, they completely insulate the bank's income statement from sudden shocks.
Exactly. If central banks slash rates to zero tomorrow, Barclays' structural hedge ensures they continue to earn that fixed rate they locked in years ago. It limits the depth of the valley during a rate-cutting cycle.
But the inverse has to be true as well, right? I mean, a shock absorber dampens the impact of a pothole, but it also creates drag when you are trying to accelerate up a hill.
Yeah, that's the trade-off.
So when global interest rates started rising aggressively over the last couple of years, Barclays couldn't immediately capture those higher yields on their entire deposit base.
Right, because a massive portion of those funds were locked into older, lower-yielding swaps from back in the zero interest rate era.
So they had to endure a lag effect.
They did. But that lag effect brings us to what is arguably the most critical data point regarding their future profitability.
Let's hear it.
The management team noted that as those old, low-yielding swaps finally mature and roll off the books, they are currently reinvesting the proceeds into new hedges at a yield of 4.3%.
Wow. Okay, and this is where the compounding mathematical advantage becomes highly tangible.
Exactly. Because when Barclays originally modeled their forward-looking business plans and set their baseline profitability targets, they used a very conservative planning assumption.
What was the assumption?
They assumed they would only be able to reinvest that maturing hedge volume at 3.5%.
Okay, wait, so they planned for 3.5, but they are actually executing these swaps at 4.3%.
Yes. Which creates a massive positive delta of 80 basis points.
That is huge. When you apply an 80 basis point outperformance across tens of billions of pounds in rolling structural hedges, you generate a colossal, highly predictable tailwind of pure interest income.
It's basically free money falling straight to the bottom line. Group Finance Director Anna Cross was very explicit about this on the call.
What did she say?
She stated that this specific momentum in the structural hedge will drive roughly half of their planned group income growth from 2025 all the way through 2028.
Half of their growth. That effectively de-risks their forward guidance.
It really does. They aren't relying entirely on their investment bankers having a hot hand or hoping that consumer credit card spending randomly spikes.
Right. They have a mechanical, locked-in yield advantage rolling right through their balance sheet for the next 3 years.
Exactly, which perfectly bridges the gap between their Q2 outperformance and their updated management guidance for the rest of 2026.
Because, let's be honest, a strong past quarter is basically a historical artifact. The market only cares about the trajectory.
Yeah, forward guidance is everything. And management used this call to significantly upgrade their forward-looking targets.
Let's go through the upgraded targets.
Yeah.
We raised their 2026 group income guidance to roughly £31.5 billion, up from their original target of £30 billion.
Right. And a £1.5 billion upward revision is a massive signal of internal confidence regarding the stability of that revenue.
Furthermore, they isolated the core lending machinery by upgrading their group net interest income guidance to more than £13.7 billion.
And it's important to note, that figure explicitly excludes the volatile investment bank and head office numbers.
Okay. So it confirms that the underlying retail and corporate lending franchises are accelerating on their own.
Exactly. And for you, the investor holding the stock, this upgraded trajectory immediately translates into capital return.
The best kind of translation. Management announced £1.8 billion in shareholder distributions for Q2 alone.
That is just massive.
Yeah.
And that's split between a £1 billion share buyback and an £800 million dividend.
If you aggregate the first half of the year, total distributions hit £2.3 billion.
Which represents a 61% increase compared to the first half of last year.
61%. They are aggressively shrinking the equity base and just handing cash back to the owners.
Which forces the market to constantly reevaluate the per-share valuation.
A 61% increase in capital returns is exactly the signal you want from a bank operating at a 16% RoTE.
Totally.
However...
there's always a however. Yes. Amidst all these upgraded targets, there was a specific line item in the guidance that warrants some pretty intense scrutiny.
You're talking about the SCA.
Yes. The management team disclosed plans to take up to £500 million in what they call structural cost actions, or SCA, in the second half of 2026.
Okay, if I'm an investor and I hear a company is firing on all cylinders, and then suddenly they announce a £500 million restructuring charge in the back half of the year, that sounds like a glaring red flag.
It definitely forces the question, right? Are they just masking operational failures, or have they severely mismanaged their legacy cost base?
Are they just burning cash?
Well, the term structural cost actions is classic corporate obfuscation, I'll give you that.
Right.
But in this specific context, taking the charge is arguably one of the most structurally bullish signals in the entire report.
Really? How so?
Because these are accounting charges taken for aggressive investments in modernization, automation, and deferred technological integration.
Oh, I see. Because Barclays generated such massive excess profitability in the first half of the year, largely from that equities pivot and the hedge tailwinds we just talked about, they now have the financial capacity to absorb heavy, one-time modernization costs.
Exactly. They can do it without jeopardizing their dividend or their overall profitability targets for the year.
So they're utilizing their current surplus to aggressively restructure their operations and permanently lower their future run rate expenses.
That is exactly what they're doing.
Let's look at exactly where that £500 million is being deployed. Because they aren't just paying severance to shrink the headcount, right?
No, they are doing some deep technological integration. For instance, they recently acquired Tesco Bank's retail banking business in the UK.
Right.
And they also acquired the best egg portfolio in the US.
And integrating distinct banking systems, migrating all those customer databases, decommissioning old legacy servers, all of that requires massive upfront capital.
Huge amounts of capital. They're also taking 5 disparate legacy client access platforms in their corporate banking division and merging them into a single unified digital interface.
They called it iPortal in the transcript, right?
Yes, iPortal. But beyond just the tech stack, they are using this capital to fundamentally restructure their employee compensation models.
Shifting a larger percentage of total remuneration away from fixed salaries and into variable performance pay.
Which is a brilliant, critical risk management tool.
Because by moving fixed costs to variable costs, they build immense flexibility into the bank's operational leverage.
Right. If the macroeconomic environment suddenly deteriorates and revenues fall, their compensation expenses will just automatically contract.
That perfectly protects their baseline profitability.
Exactly. But honestly, the most compelling metric regarding this £500 million SCA charge is the management's projected payback period.
Yeah, they were very explicit about this on the call. They expect a return on investment of roughly 100% on this specific spend within 12 months.
Let that sink in. They are taking a £500 million hit to the income statement in late 2026 to generate £500 million in sustainable annualized cost savings starting in 2027.
And that continues indefinitely. It is an extreme form of delayed gratification.
Right, and it's something that only a highly capitalized, highly profitable institution can really afford to execute right now.
They are essentially building a massive moat around their future profitability.
They absolutely are.
Okay, so if we synthesize all of these data points, the absolute revenue growth, the structural shifts in the investment bank, the hedging mechanics, and this capital allocation strategy, we have to take a definitive stance on the underlying health of this institution.
Yeah, we have to call it. And based purely on the mechanics revealed in this earnings transcript, the definitive posture has to be highly bullish on Barclays' execution.
I agree. They are successfully pulling off one of the most difficult maneuvers in global finance. They are pivoting a massive legacy fixed income trading house into a capital-efficient, fee-based equities and prime brokerage operation.
And they're doing it while rapidly expanding their overall returns.
The success of that diversification is evident across the board. Like, while the investment bank dominates all the financial headlines, their domestic UK corporate lending quietly grew by 12% year over year.
And that 12% is a vital macroeconomic data point.
Because the CEO pointed out that while UK corporates have actually had the balance sheet capacity to invest for several quarters, they lacked the economic confidence to deploy the capital.
Exactly. And that sentiment is finally breaking. A 12% expansion in corporate lending proves that Barclays is successfully capturing that returning domestic confidence.
And they're converting it into high-quality, long-term loan growth.
Right. Coupled with a distribution plan that has returned £9 billion to shareholders since 2024, the execution is incredibly tight.
It's extremely impressive. But we have established the bull case, and our analysis must remain objective.
Yes, we have to look at the other side.
We have to invite the thesis and look for the structural fractures. The Q2 call was overwhelmingly positive, but there was a specific mechanical headwind operating within their U.S. consumer bank that requires dissection.
Right, the Best Egg acquisition.
Yeah. They recently acquired that Best Egg portfolio, which added £11 billion in managed consumer balances.
And expanding their consumer credit footprint in the U.S. seems like a standard, solid growth vector on the surface.
It does. But the underlying mechanics of how they fund and offload those loans is currently creating a real margin squeeze.
Yes. The issue stems from their specific operational architecture over in the U.S. Barclays does not simply hold all of these consumer credit card loans on their own balance sheet.
Oh, they don't?
No, they heavily utilize what's known as an originate-to-distribute model.
Okay, let's break that down.
So in this model, Barclays originates the credit card loan, they underwrite the consumer risk, and then they bundle tens of thousands of these individual loans into a massive special purpose vehicle.
Like a huge package of debt.
Exactly. Then they tranche this bundled debt into securities and sell those securities to institutional investors in the open market.
While typically retaining the servicing rights and a portion of the fee income, I assume?
Right. And this securitization process allows them to recycle their capital continuously rather than just tying it all up in long-term consumer debt.
That sounds like a brilliant model for velocity. You're just constantly churning and earning fees.
It is great for velocity, but it leaves them highly exposed to friction in the securitization markets.
Because when Barclays bundles those loans and takes them to the open market, institutional investors demand a yield that is directly tied to benchmark treasury rates.
Precisely. And because global benchmark interest rates have remained elevated for way longer than the market initially anticipated, the investors buying these bundles are demanding higher and higher yields to take on the risk.
Okay, but couldn't Barclays just raise the interest rates they charge the consumers on the credit cards to match?
Well, that's the problem. The underlying annual percentage rates, the APRs that Barclays charges the consumer on the actual credit cards, are somewhat sticky.
Right. They don't adjust upward instantly or infinitely. There are limits.
Exactly. So that creates a mechanical compression on their profit margin.
Because the yield demanded by the institutional buyer of the securitized bundle is rising faster than the interest rate Barclays is collecting from the consumer.
You've got it.
Yeah.
Consequently, to make the bundle attractive to the market, Barclays actually has to sell the securities at a slight discount to what they historically modeled.
And this dynamic directly compresses the non-interest income line within that U.S. consumer bank division.
Yes. It is a textbook example of how prolonged, elevated benchmark rates can create friction, even in a business that is fundamentally growing its loan volume.
It is a minor drag on the overall group, but it's worth noting. Although, as Group Finance Director Anna Cross noted, the underlying credit quality of the U.S. consumer remains highly resilient.
Yeah, that was a really interesting point. Delinquencies actually trended downward in the quarter.
She mentioned that was aided by seasonal tax refunds bolstering consumer balance sheets.
Right, so the margin squeeze in securitization is really just a mechanical reality of the current rate cycle. It is not a signal of deteriorating underwriting standards or bad loans.
Okay, that's a crucial distinction. It is a headwind, but it is vastly overpowered by the tailwinds in equities and that massive structural hedge we talked about.
Vastly overpowered. The overall portrait is an institution that is systematically stripping away legacy inefficiencies, optimizing its capital allocation, and returning the excess directly to shareholders.
It is the rare intersection of macroeconomic tailwinds meeting highly disciplined internal management execution.
Right. The rolling structural hedge yields meeting the equities pivot and the structural cost actions.
And when an institution manages to align its internal architecture with the external macro environment like that, you get the kind of compounding financial outperformance that results in a 43% EPS expansion.
It all clicks together perfectly.
It really does. But as we close this deep dive, there is one final structural reality buried in the transcript regarding that U.S. consumer bank that I think completely shifts the valuation paradigm.
Oh, the physical footprint data.
Yes. We just discussed the securitization headwinds, but if you look at the physical footprint of that division, the numbers are absolutely staggering.
They are kind of unbelievable for a bank this old.
Right. Barclays U.S. Consumer Bank currently services over 25 million active customers. They manage billions in revolving credit. Yet they operate with exactly 0 physical retail branches in the United States.
0 branches.
None. There is no brick and mortar network, no physical teller overhead, and none of the legacy real estate costs typically associated with a consumer bank of that massive scale.
It operates entirely as a digital-first, cloud-native entity.
Which is wild. The U.S. division is essentially functioning with the infrastructure and the operational leverage of a modern Silicon Valley fintech firm.
But it is bolted onto the balance sheet of a 300-year-old regulated British bank.
And this forces a complete reevaluation of how the market prices this stock. I mean, Wall Street notoriously assigns really low earnings multiples to legacy British banks.
Right, because they are traditionally viewed as these lumbering brick-and-mortar dinosaurs permanently burdened by insurmountable legacy costs.
But if the engine driving significant portions of their growth, this 25 million customer U.S. division, is operating with the 0 branch footprint and the high margin scalability of a fintech startup, I mean, the traditional valuation models are fundamentally flawed.
They really are. And if management successfully executes those £500 million structural cost actions.
Right, the SCA.
Yeah, and modernizes the rest of the legacy infrastructure to mirror the efficiency of their U.S. division, the latent upside in the stock could be dramatically higher than a standard banking multiple implies.
You are looking at an ancient brand, but beneath the surface, you are analyzing the mechanics of a stealth fintech powerhouse.
That's exactly what it is, a stealth fintech.
Incredible. Well, thank you all for joining us on this deep dive into the underlying realities of the market. Keep examining the mechanics, and we will see you next time.